Hey guys, welcome back to the channel. In today's video, we're diving into some seriously interesting market insights from none other than Tom Lee, Wall Street veteran and co-founder of Fundstrat Capital. He just dropped a fresh update and he's making a bold claim that the stock market may have just hit its structural low last week. And he's basing this call on the VIX, the market's fear index. Now, whether you're deep in the investing game or just trying to understand what's going on with all this volatility, this is a video you don't want to miss. We're going to take a look at the clip of Tom Lee's latest appearance, and after that, I'm going to break it all down for you. I'll give you my take on what he said, the macro outlook he laid out, and his thoughts on some big names like Nvidia, Tesla, and MicroStrategy. So, if you only watch one finance video today, make it this one. And stick around till the very end because I'll be unpacking a lot that could really shape how you approach your portfolio moving forward. Smash that like button. Let's shoot for 1,000 likes on this one. Don't forget to share it with your investing friends, drop your thoughts in the comments, and of course hit subscribe so you never miss out on key market updates like this. Alright, let's jump into the clip and see exactly what Tom Lee had to say.
This is our update for the Shots ETF for the week of April 11th. I want to cover some particulars before giving you some macro thoughts and some thoughts on some of the Granny holdings itself. The price as of April 11th was $17.67 and total assets of $829 million. Over the past week, Granny Shots rose 8.47% compared to a 5.73% rise in the S&P, or relative performance of 275 basis points. Like last week, I think it's important to focus on the macro because correlations of stocks have increased, and so I just thought I would give you our latest macro thoughts. The first is, I think that there are signs, and I'll explain why, that stocks have shown evidence of a bottom. I think it's a structural low decisively, and it's possibly the low for 2025. Here's a price chart of the S&P over the past week, and as you can see, the S&P was 56.69 before Tariff Liberation Day, fell to a low of 48.35 on April 7th, and has recovered somewhat to around 5,300. And we think that there's still roughly 2 to 3% upside in the near term towards 5,500. Now, the S&P has pulled back, but as you can see, it is moving along this near-term trend line. So again, I wouldn't turn too bearish near term. Stocks fell earlier this week, and this has to do with on April 16th, Wednesday, when Fed Chair Powell spoke at the Economic Club of Chicago. Now, he said something consistent with his last appearance, which was at the NAB Business Writers Forum. He says that the Fed has to be patient here because they just don't know what the effects of tariffs will be on either growth or employment. And until they have an idea what the tariff policy is, the Fed has to be patient. Now, that didn't sit well with the president, who this morning said the Fed is too late and too wrong, and he's citing the ECB, and the ECB is actually making cuts because they view tariffs as a demand shock. But I don't think what Powell said is actually sitting poorly with markets. What I'm highlighting here is that when Fed Chair Powell spoke on Wednesday, long-term interest rates, the 10-year yield actually fell. That's in contrast to his same exact comments that he made at the NABE on April 4th, where yields actually rose. So literally he makes the same comments, but 12 days apart, yields actually fall. I think that's a good sign. More importantly, the VIX did rise on Wednesday to 32, but that's well below the VIX levels that we saw over 50 on April 7th and April 8th when the S&P was at 4,800. What am I trying to get at? I think the stock market is in a better place today than it was when the S&P was at 4,800. Just recall there was a lot of panic, there was a lot of fear, yields were rising. It didn't look like the president was going to budge. Remember the talk from Howard Lutnick about he's not negotiating. Well, things have changed, and that's why I think stocks are in a better place. But there is some significance to the fact that the VIX was at 60 and now is at 31. Let me explain. There's three numbers I want to highlight. The VIX was at 60 on April 7th, and then on April 11th, the VIX closed at 37.56, which is an important level. And then earlier this week, it closed at below 31. Okay, why is that? Well, there's an old adage that says you buy stocks when the VIX is greater than 50, and good things start to happen when the VIX falls below 30. The VIX above 60 has only happened a handful of times. It happened, of course, this past week. It happened during COVID, and it happened during the GFC. Well, let's look at the GFC. Let's use those three dates or those three levels I marked. The VIX above 60, which was October 2008. The VIX falling below 37.56, which didn't happen until January 09. And the VIX closing below 31. Well, importantly, when you close below 31, you were past the low because the low was March 09. During COVID, the VIX didn't close below 37.56 until March 24th, 2020, and it didn't close below 31 until April 2020, but you were already past the low. That's why I think it's important to consider that some important structural low took place this past week. Okay, so I think that we're still in a bull market. I'm just not clear if it's a V-shaped recovery like 2020 or it's a range market like 2011. Intuitively, I'm going to say that it makes sense that we made a bottom, but we're maybe range bound for a bit. And that's because people are worried that there's other shoes to drop. I mean, the tariff war with China could turn into a Cold War. Investors are going to worry about the ripple effects from this shock leading to a global recession. These are extreme views, by the way. That some people are going to worry about a financial crisis from all this deleveraging. And inflation expectations could surge to an extent that we get greedflation. Remember, that's like companies basically raising prices, and it's going to force the Fed to hike. And of course, if estimates fall more than 20%, stocks have downside because the stock market already had a 20% drawdown. But the internal low seems to have been in place. This is the percentage of stocks above the 50-day moving average at the top and above the 200-day moving average on the bottom. Below 20% is a big deal because over the last 16 years, the S&P was higher 6 months and 12 months later. In fact, if you look at 3 months later, outside of 2022, the stock market was higher 3 months later every single time. So I think we did make a structural low. Now, the second thing to keep in mind is the macro is going to be messy for a couple of obvious reasons. We just don't know what the tariff policy is going to be, and we just don't know what the economic ripples are going to be. Polymarket says the market is only expecting a 37% chance of a China-US trade deal before June. That's not great. It'd be great to see this above 50%. The odds of a recession, according to Polymarket, betting is 53%. That's not great, but it's definitely better than 68%, which is where it was a week ago. And I think I'm encouraged by the fact that high yield has rallied almost 50 basis points from a week ago. That's a pretty significant move from 461 to 414. So I think it's helpful to look at things on the margin. So are things getting less bad or better? It's like a relative thing. And I'd say that the relative news has been good. This is a Truth Social post from the president this morning. He says he had a productive call with the president of Mexico, and he met with the highest level of Japanese trade representatives, and he's meeting with Italy today. That's great news. And maybe notably, he says every nation, including China, wants to meet. Okay, this is on April 17th. I think that's a positive tweet. And we know that the White House has been moving towards de-escalation. Anyways, from the delaying of the tariffs on April 9th to the CBP actions late Friday last week. And we know there's more voices in the room. You know, we have the Mag 7, the automakers, and Jamie Dimon also having influence on the president and his actions, which is a good thing. Which gets us to the economy. I think the economy's been resilient. I mean, first of all, CEO of Bank of America, Brian Moynihan, said that small businesses, look, they're sitting on their hands, but the asset quality hasn't deteriorated. And he said the consumer is holding up, especially when it comes to services. And I think that's a good sign. We know that there is going to be economic ripples, though, because tourism from abroad to the US is down from Canada to Mexico to Europe and Asia. And United is so unsure about the profit outlook, they had to give two earnings scenarios. Okay, bottom line, the macro is messy, but the economy is not unraveling yet. All right, so let's look at granny shots and the themes where relative performance stood out. The strongest is energy and cybersecurity over the past week. That's names like Palantir and GE Vernova and CrowdStrike. And the style tilt. And this is, again, balanced quarterly, but style tilt had the strongest positive contribution to the granny shots portfolio. And as you can see, it's not a surprise to see the drags coming from names like Caterpillar. But let's talk about stocks that have been taking particular hits in the last couple of days. One of them is Nvidia, because it fell 10% on Wednesday, and it really hasn't recovered. Now, you're wondering, why is Nvidia getting hit so hard? Well, it has to do with an export restriction. Nvidia makes this H20 chip, which is designed to sell in a way that was acceptable to the US to export to China. It's actually a fairly important chip for Nvidia, more than $10 billion of sales. But at the moment, because Nvidia follows the letter of the law. The US does not want them to ship any more H20 chips to China. Well, Dana Ives put it succinctly. Basically, the White House knows that China needs these Nvidia chips. This is part of the tariff war. So Nvidia is caught in the crossfire. Okay, well, you might be wondering, does this mean you should get out of Nvidia? Analysts have already adjusted their estimates for Nvidia. And Nvidia trades, okay, it's 18 times year ahead earnings, year plus 2. The semiconductor group trades closer to 26 times. I mean, even a stock like Intel trades at 14 times. Nvidia is trading as if it doesn't grow. I mean, it's trading below market multiple. Would I be selling Nvidia here? No. Does this sound like an opportunity to be adding? I would say so. So to me, unless you think this tariff war turns into a Cold War, which it could, at the end of the day, there's only one company that makes chips that are important to AI, and that's Nvidia. And as you can see, Nvidia was washed out. It fell to $87 on April 7th. I mean, even now at 100, it's still almost 20% above that level. Okay, another company that's reporting earnings next week that's a granny shots is Tesla. Now, as you know, Tesla's been taking a lot of hits, partly because of Elon Musk's role at the White House and Doge, and we know it's been hitting demand. But Tesla has responded positively in 3 of the last 4 earnings reports. So as much as dire expectations have come into play, I do think Tesla is pretty washed out. And again, it fell to 214 on April 7th, which I think is a washed out level. It's at 240 right now. So I think a lot of bad news got priced into Tesla. And the last stock I want to point out that looks really washed out is MicroStrategy. The reason I'm pointing this one out, and MicroStrategy, for those who are not as familiar with the name, they are a levered Bitcoin equity. They're levered to Bitcoin because they are using Bitcoin as a treasury strategy. Bitcoin itself has acted relatively better recently, so it's starting to improve. But as you can see, MicroStrategy fell to 231 on March 11th. And then on the panic day of April 8th, when everything in the stock market was selling off, MicroStrategy fell to 236. That means it actually held at a higher low on a day when the entire market was crashing. So again, I think MicroStrategy is showing signs of being really washed out. So that gets us to, what are granny shots? Well, granny shots refers to a way of shooting free throws, and it's was popularized by Rick Barry, NBA Hall of Famer, who made 90% of his shots. Granny shots aren't as sexy looking as shooting overhanded, but the way we do granny shots in this fund is we look at the most important structural themes for markets. That's things like millennial strategy, global labor suppliers, the rise of AI and automation, energy and cybersecurity, and easing financial conditions. We also look at shorter-term tactical things like style tilt, seasonality, and the PMI recovery. Now, for a stock to be a granny shot, not only should it be associated with one of these themes, and it has to be one of the strongest stocks in each of these themes, it has to appear more than once. That's what makes it a granny shot. So the stocks that appear most often are really the strongest names because they are associated with multiple themes. Think of it this way. They're going to have multiple ways to work because there's multiple drivers for the story. That's what makes it a granny shot. There's a lot more detail on our fact sheet, which can be found at grannyshots.com. And this is the investment team. Thanks for listening, and I'll speak to you soon.
Now let's dive deep into what Tom Lee actually said. Because while on the surface it sounds like just another market update, there's a lot going on under the hood. Alright, so Tom starts off with a performance update on the Granny Shots ETF. And yes, that's actually what it's called. A clever nod to safe, consistent stock picks just like the reliable granny shot in basketball. As of April 11th, the ETF was sitting at $17.67 with total assets of $829 million, and it had just outperformed the S&P 500 with an impressive 8.47% gain versus 5.73% for the S&P. That's about a 275 basis point spread. That's no joke. But here's where it gets real interesting. Tom doesn't just stop at numbers, he shifts the spotlight to macro trends which, as he points out, are dominating stock performance right now due to rising correlations. And this is a big deal. When stock correlations rise, it means that the market is being driven more by macro news, things like interest rates, Fed policy, geopolitics, than by individual company fundamentals. One of the boldest claims Tom makes, and it's the heart of this update, is that we may have seen the structural low in the stock market. Not just any bounce, but potentially the low of 2025. That's a strong statement. He walks us through the price action of the S&P 500. The market hit a low of 4,835 on April 7th, after something he jokingly called Tariff Liberation Day, but then recovered to around 5,300. And he's seeing upside towards 5,500 in the short term. He draws attention to the fact that despite recent pullbacks, the S&P is still riding along a bullish near-term trendline. So he's not turning bearish, he's just urging some cautious optimism. Then he gets into the big elephant in the room, the Federal Reserve. Now, Tom points to an interesting divergence. When Fed Chair Powell spoke on April 16th, he repeated pretty much exactly what he said 12 days earlier at another event. The Fed has to stay patient and assess the effects of tariffs on growth and employment. But here's the kicker. Markets reacted differently. On April 4th, rates went up after his comments. But on April 16th, rates dropped. That's a big shift in sentiment, and Lee's interpretation? That's a bullish sign. It suggests the market is no longer spooked by Powell's cautious tone. Now let's talk about one of the most important parts of the whole interview, the VIX, also known as the fear gauge. Tom Lee breaks it down brilliantly. The VIX hit a high of 60 on April 7th, a level we've only seen during major crises like the global financial crisis back in 2008 and COVID-19 in 2020, but since then, it's dropped significantly, closing below 37.56 on April 11th and even dipping below 31 this week. Now here's why this matters. There's a market saying that goes, buy when the VIX is over 50. And even more important, good things start happening when the VIX drops below 30. Tom uses historical analogs to drive this point home. During the GFC, VIX peaked in October 2008, fell below 37 in January 2009, and dropped below 31 after the March 2009 market bottom. During COVID, VIX dropped below 37 on March 24th, and below 31 in April, again, after the low had already been made. So Tom's takeaway? The worst is likely behind us. That volatility spike we saw might have marked the bottom, and the fact that the VIX is now calming down suggests markets are stabilizing. He's not calling for a rocket ship rally though. Tom makes it clear, we could either be looking at a V-shaped recovery like 2020 or more of a range-bound market like we saw in 2011, and honestly, I appreciate that nuance. Why might we go range-bound? Because, as he points out, there's still a lot of uncertainty. Tariff war with China potentially escalating, risk of a Cold War or global recession, fears of greedflation. That's when companies raise prices just because they can, not because of actual inflationary pressure, and of course the Fed might be forced to tighten if expectations for inflation spike again. Okay, so this next bit is really technical, but honestly, it's crucial. Tom looks at the percentage of stocks that are above their 50-day and 200-day moving averages, and he says that when those numbers drop below 20%, it's historically a signal for a market bottom. Over the past 16 years, every time that's happened, well, except for 2022, the market has ended up higher 3, 6, and 12 months later. So what does that mean for us? We just hit one of those zones, and historically that means a rally could be coming. That said, Tom's definitely not saying it's all sunshine and rainbows. He's realistic about where things stand. He actually brings in polymarket data, showing there's only a 37% chance of a US-China trade deal before June. And there's a 53% chance of recession, which is better than the 68% from last week, but still, it's nothing to celebrate just yet. Still, he finds some encouragement in the fact that high-yield credit markets have rallied. That's usually a leading indicator. When junk bonds rally, it suggests the market isn't really pricing in disaster. So, what's my big takeaway from all this? Tom Lee's giving us a well-balanced, glass-half-full kind of analysis. He's not ignoring the risks. We're talking about geopolitical tension, stubborn inflation, and policy uncertainty. But he's also saying, hey, we just might have seen the bottom, and he's backing up that claim with real data. VIX levels, interest rate reactions, technical breadth, and market psychology. As someone who follows the markets every day, I've got to say, I find his argument pretty convincing. He's not just throwing darts here. He's using a mix of history, price action, and sentiment to build his case. And right now, that narrative is cautiously bullish. If you found this breakdown helpful, make sure to hit that like button and subscribe for more insights like this. I'll keep reacting to these expert interviews and breaking down what they really mean for you as an investor. What do you think? Is the bottom in, or are we in for more pain ahead? Drop your thoughts in the comments. I'd really love to hear your take. Thanks for watching, and I'll catch you in the next one. Peace.